Ponzi schemes. A Ponzi scheme is a fraudulent investing scam promising high rates of return with little risk to investors. The scheme generates returns for early investors by acquiring new investors. This is similar to a pyramid scheme in that both are based on using new investors and their funds to pay their earlier backers. It was actually named after Charles Ponzi, who tricked thousands of New England residents into investing in a postage stamp speculation scheme back in the 1920s. Pyramid schemes. A pyramid scheme is a business model that recruits members via a promise of payments or services for enrolling others into the scheme rather than supplying investments or sale of products. As recruiting multiplies, recruiting becomes quickly impossible and most members are unable to profit. As such, pyramid schemes are unsustainable and often illegal. Phishing. And not that kind of phishing. This scam involves tricksters trying to lure the victim into giving their private information. Phishers send emails or create web pages that are designed to collect an individual's online bank, credit card, or other login information. Because they look like legitimate websites or emails from financial institutions or companies like PayPal, victims trust them and enter their personal information. But you should never do this, because you'll be in big trouble. Bank loan or credit card scams. These scams involve offers of fake loans or credit facilities, usually at attractive rates to lure victims. The scammer will require upfront payment as a processing fee or deposit after receiving the payment. They disappear and the loan never materializes. Fake check scams. Scammers send a fraudulent check, often for more than the amount owed, and ask the victim to wire back the difference. This is common in online marketplace scams and scams targeting job seekers who are told the check is for supplies or a starting bonus. Investment scams. These involve the illegal sale or purported sale of financial instruments. The typical investment scam is characterized by offers of guaranteed returns at no risk to the investors. Fraudulent investment opportunities are an example of this, or speculative ventures. Charity fraud. Money is solicited or put up for fake charitable organizations. This often occurs after natural disasters or during holiday seasons. But charity frauds are always year-round. The scammer takes advantage of people's goodwill and then steals the donations for himself. Lottery scams. These scams involve telling the victim that they have won a large amount of money in a lottery, but must pay a fee to claim their prize. There is no prize, and the scammer pockets the fee paid by the victim. Employment scams. Job seekers are told they've secured a job, but must pay fees for things like background checks, uniforms, or equipment. After the victim pays, the scammer disappears and the job never materializes. IRS and tax scams. These scams involve imposters posing as tax authorities. They try to get the victims to turn over their personal information or to contact them and con them into paying money or supposedly owed money to the IRS. Now, the IRS does not initiate contact with taxpayers by email, text messages, or social media channels to request personal or financial information. Tech support scams. Users are baited by fake alerts or advertisements claiming their systems are compromised and urgently require technical support. Victims pay for unnecessary technical support services just to fix an issue that doesn't even exist, and then give scammers access to the devices, leading to a potential identity theft. Dating and romance scams. Scammers create fake profiles on dating sites and apps, or contact their target through popular social media sites like Instagram, Facebook, or Google Hangouts. The scammers strike up a relationship with their targets to build their trust, sometimes talking or chatting several times a day. Then they make up a story and ask for money. Criminals break large sums of illicit cash into smaller, less suspicious amounts to evade detection. They use Smurfs or money mules to deposit these amounts across multiple bank accounts, often staying below the amount that will require identification, which is $10,000. For example, a cartel might distribute $500,000 among 50 accomplices, each depositing $9,999 into separate accounts. This method exploits tax oversight in cash-heavy transactions and is a hallmark of the placement stage of money laundering. Red flags include frequent small cash deposits by the same individual or network, and the use of multiple accounts with no clear business purpose. Transactions just below reporting thresholds are going to be a red flag for these agencies. Fake businesses with no real operations are created to mask illicit funds. Criminals layer transactions through these entities, often registered in jurisdictions with weak regulations. For instance, a shell company might pose as a consulting firm and invoice a criminal syndicate for fictitious services. That's how it works. Placement is number one. Dirty cash is deposited into the shell's company account, and then it goes into layering. Funds are moved through offshore accounts or loans to other entities. And then third is integration. Clean money is invested in real estate or luxury assets. Example of this is the Panama Papers leak exposed how shell companies hid billions for politicians and celebrities. Casino laundering. Dirty cash is just converted into chips, gambled minimally, then cashed out as winnings. A criminal might bring $100,000, for instance, to a casino, play a few rounds of blackjack, and leave with another $100,000. Or a $95,000 check labeled as gambling proceeds. Casinos are ideal due to high cash flow and lack of tracking of small bets. But to prevent this, casinos now file suspicious activity reports for large chip purchases without corresponding gameplay. Cryptocurrency laundering. Criminals use private coins or mixers to obscure blockchain trails. For example, a hacker might steal Bitcoin, send it through a mixer that pools funds with others, then withdraws clean coins to a new wallet. Emerging threats are the NFT wash trading, artificially inflating NFT prices just to launder money, and decentralized exchanges, peer-to-peer platforms with minimal KYC checks. Bank capture. Criminals bribe bank officials to bypass AML controls. In one case, a Colombian cartel infiltrated a bank, approving fake loans to move $80 million globally. Signs of this are usually high transaction volumes in a small bank and employees living way beyond their means. Transaction laundering. Fake online stores process payments for illegal goods. A dark web seller might use a sham Toy Store merchant account to process credit card payments, making transactions appear more legitimate. Now, the feds detect this by businesses reported industry and transaction patterns. Now, these people will usually get detected by the feds when there's a mismatch between a business's reported industry and transaction patterns. Pump and dump schemes. Scammers hype a low-value crypto or stock, usually a celebrity-endorsed meme coin, then sell their holdings once prices spike, leaving investors with worthless assets. The recent case is the Hawk2 meme coin. Surged 1,000% after viral tweets, then crashed when insiders dumped shares. Then you have the overpayment scams. Overpayment scams often target individuals selling goods or services. The scammer sounds a counterfeit check for an amount exceeding the agreed price and requests the seller to refund the excess amount. After the refund is sent, the original check bounces, leaving the seller out of pocket for the refunded amount. This type of scam exploits the delay between the deposit of a check and its clearance. They involve fraudsters pretending to be someone the victim knows or trusts, such as a family member, government official, or company representative. They may claim to be in urgent need of money due to an emergency or demand payment for supposed fines or bills. These scams often create a sense of urgency to pressure the victim into acting quickly without verifying the claim. With real estate, there's a whole bunch of scams here as well. Given their complexity and significant financial stakes, they have long been fertile ground for fraudulent activities. Rental scams are prevalent in the real estate sector, often targeting individuals seeking housing. Scammers typically post fake rental listings on platforms like Craigslist or Facebook. Once contacted, the scammer posing as the landlord may request an upfront payment, such as a security deposit or first month's rent, before the prospective tenant can view the property. In many cases, a property either doesn't exist or is already occupied, leaving the victim without their money and without a place to live. A notable example involves scammers exploiting platforms like Facebook Marketplace and Airbnb to create fake property listings, leaving victims homeless and financially devastated.